Now, in this context of what is happening around the world, let us now look at our own country. So now elections are beyond us and a new government has been formed, and the new government is making a lot of effort to tell all of us that it is just continuation of the old government. So despite a reduced majority, etc., the message is that what was happening before the election will continue to happen. And reflecting this, after the crash of 4th June, markets have come back and made new highs. Now, analysts, be it political analysts, economic analysts, or even market analysts, everyone is busy making predictions on how the new government will function. Each person is wearing the hat of finance minister and now talking of what the budget will hold for various sectors. Some are expecting that there will be greater allocation to agriculture because farmers are not supporting the government, and that is the reason why there were lesser seats won. Others are arguing that there will be greater allocation for railways and maybe construction of new roads. According to some, there will be greater fillip to industries from Andhra Pradesh and Orissa, which will be given special status. And while some others are expecting cut in income tax rates, and the list goes on. Now, each person is trying to think what the government will do so that, it creates a positive impression among the voters, because quite a few assembly elections are due and the government would not want to be in a situation where they are losing those elections. Now, each one of these whatever I have said, each one of these things may have merit. Okay, there's some logic in terms of what these analysts are saying. But the fact is that all these expectations are unlikely to be met. I'm saying all the expectations collectively are unlikely to be met. There is bound to be disappointment. And that will result in some short-term correction on budget day. So typically, the anticipation is that all these rumors and expectations will keep pushing up the market. The yo-yoing will continue. See, volatility is an inherent part. So that will happen, but the markets will keep moving up. But we can see a sharp correction on budget day. However, we cannot overemphasize the need to look at long term and to ignore the volatility of short-term big bang announcements. Typically, budgets have become quite boring, and what was earlier done during budgets, a lot of tinkering, etc., is now not being done. So if you see the last 3 or 4 budgets, the focus is more on policy announcements, long-term vision, what the government intends to do, etc. And therefore, the budgets may not contain adequate spice to push up the markets, unless, of course, anything is possible. But our expectation is that there could be some correction post-budget. But till budget, the rally is likely to continue. Now, while that is the short-term story, as I said, we need to look at long-term, and India continues to do well on macro parameters. Our long-term fundamentals are on a very strong footing. After a very impressive 8.2% growth in FY 2024, against an expectation of 8%, our growth estimates continue to be revised upwards. I think just very recently, global rating agency Fitch has revised India's financial year 2025 growth rate, GDP growth rate, to 7.2% from earlier estimates of 7%. Inflation is easing, and unlike what we saw in the UK, the current account deficit has dropped sharply to about 1.2% of GDP. RBI governor was on record saying that he expects it to be near about 1% or maybe little less than 1% also. However, that has not happened. But 1.2% from 2.53% is quite impressive. Fiscal deficit appears to be in control, again, thanks to a huge dividend by Reserve Bank of India. Corporate profit to GDP ratio has gone up. It now stands at about 4.8%. And to the best of my mind, we've not seen this number in the last 15-20 years. I remember once it was 5.2% or odd, but otherwise, corporate profit to GDP number has significantly improved. Private investments, the one number which was lagging, are now picking up, although one would have expected a higher number. And our forex reserves continue to swell. We are currently at about 640 plus billion. Challenges continue. Oil prices are again inching up. Geopolitical tensions continue. And these are never good for any economy. Unemployment was an election issue. There are sections within the country who haven't benefited from overall growth. So the economists, etc., keep talking about a K-shaped growth, meaning while some people are benefiting from the growth, some are actually not. So while all this talk is there, despite all this, our time has come. It is clearly India's decade. And as investors, it is for us to decide whether we get scared of the risks or ready ourselves to ride the roller coaster of growth. Now, I said earlier that regarding US interest rates and India's interest rates, here's one interesting piece of statistics for those who are economically inclined. In February 2022, the US Fed funds interest rate was 0.25%. Today, it is 5.5%, unchanged since August 2023. The RBI repo rate in February 2022 was 4%. Today, it is 6.5%. Now, while the two rates are not exactly comparable, if you see the difference, the spread in these two rates was 3.75% in February 2022. Today, it is just 1%. On top of it, as I mentioned earlier, while the US is very uncomfortable bringing down the interest rates, the Fed is saying that it's going to take a long time, we need to see a few things, etc. Our RBI is actually struggling to not bring it down. There's so much of pressure, but we keep saying, no, we still want to monitor, etc., etc. Now, what does this tell us? What does the shrinkage in interest rate tell us? Now, very simply, again, without going into too much of economics theory, if a poor country or a relatively unattractive investment destination has to attract capital, it has to increase its interest rate. So, traditionally, historically, if you've seen, interest rates in India are much higher than the interest rates in US. Today, it is shrinking. What it means is that from an investor's perspective, the risk premium associated with investing in India has significantly reduced. So earlier concept of capital flowing back whenever interest rates are raised in the US, etc., those risks have significantly reduced. Now, a global investor is willing to bet on India even when he does not see a significant premium on interest rates. The spread is not very high. So the investor is saying, doesn't matter, I will still invest in India. Let us look one step deeper and maybe I will stop. I'm probably exceeding my limit. But if inflation is 5%, our target is 4%, we are somewhere around 4.25%, we are okay with 4 to 6%. But let me take an average of our comfortable band. Let's say inflation is 5%. And let's conservatively say GDP growth is 7%. Mind you, the 7% is real GDP growth rate, meaning after accommodating for interest. That means in nominal terms, GDP growth rate is 12%. That means our country, if we do not factor in inflation, is actually growing at 12%. If that is the average growth in India, then well-managed professional businesses which know how to run the business, good management, etc., those companies should grow at least at 15 to 16%. And that is what is likely to be the market returns in India. And that is a very good number. So whatever government policies, whatever economic ups and downs, etc., investments in India should, if we are careful with which kind of companies are we associating with and putting our faith in, then a 15 to 16% return is something that is a very reasonable expectation. And that is why I end it on this note with a note that this is not the time to think that, okay, markets have been at very high levels and, I should shift to safety. Asset allocation is important, but please do not miss out on this growth phase. Thank you. Ram, take over, please.
Yeah, thanks, Manoj. I think we have another 6 minutes left on this bridge, unfortunately, because of the scheduling issue. So should we shift right now, Manoj, so that everybody is consciously aware before we all get...
What I suggest, Ram, one of us will shift, the other person will continue, we'll wait there. And then, so that's a 4:30 meeting. Since I am the host there, I will leave this meeting and open the meeting there. Requesting all the people who have participated, who have joined this meeting to please, Ram, is the chat link clearly visible?
So it is there. With a quick announcement, we've been considering about rebranding our organization for some time, basically because there was feedback that the verb Jamā that we intended to have. So there's a lot of mispronunciation. And from an internet search perspective also, there are two issues that we are seeing. One is there is a Journal of American Medical Association, JAMA, which is very popular on the internet. And so a lot of search, when somebody types JAMA, it's not giving the intended results to us. And second is even on Google Maps or Google local searches, when somebody types JMA, there are a lot of masjids are coming up. So there's a lot of ambiguity about what is the brand, what does it stand for. And this we came to know through a lot of verbal feedback. And we also felt that over the last 7-8 years that we've been here, we've evolved our whole organizational rationale is about quantitative research, mathematical rigor, and principles to create wealth. So there are maxims to maximize wealth. And mathematically speaking, there are axioms, which are basically principles and truths that we use. So we chose the term Maxiom, MAXIOM, as something that we will use to represent the organization. So I thought I'll share that with you. I'll just share my screen, a couple of slides on that. Just a minute. Not able to stop the share. Is the sharing happening? Can you see the screen share? Just a minute.
No.
Can you see my screen now?
Yes.
Yes,
Ah.
Ram.
Okay, thank you. So the brand, so we are going with the term Maxium, as I said, because this better encapsulates a mission, which is using data science and quantitative axioms to maximize investor wealth. And it stands for technological innovation with peak financial principles. And it is derived from these two terms, which again signifies our core principle. And we've retained most of the previous logo. We've just made a small tweak to the logo, which continues to have a 45-degree upward arrow and ascending blue tints, which symbolizes growth and prosperity. This is a quick announcement on this. We are going to, over the next few days, we're going to change the website, etc. And anything that you type on Jamā Wealth will automatically get redirected to Maxium. So the name of the company, the legal entity, everything remains the same. It's just the brand we are changing, and we are uploading the revised disclosure documents on the regulator's website, etc., so that everybody knows. We'll also have a tag which says formerly known as Jamā Wealth, so that there is no confusion about what suddenly you're seeing something new. So that is a quick announcement. I think Manoj has already covered about the macros, and I will briefly talk about how our portfolios have done over the last few years. The main trigger for this is that the strategy that we call as Spark has now completed 3 years. And the strategy that the large mid-cap strategy, which was the first main strategy that we launched, which is Jewel, that started in August 2019. So by the time we reconvene for the next call, it would have completed 5 years. It's almost at 5 years now. So I'll just quickly do a review of how they have done. And I'll also introduce our new strategy, GEM, which is a mix of quality and momentum towards the end of this call. And then we'll obviously have time for Q&A. And Manoj and I will be happy to answer any questions on that. So a core investment philosophy continues to be roots and wings. And here, when we say roots, we like companies with strong balance sheets and with low debt. Whenever we've added any company, we've made sure that it meets the roots criteria. For us, high return on equity is a very, very important aspect, because over time, when a company is growing its profits and feeding it back to build assets for the company, which is reflected in the equity base, it creates a compounding machine. So more net worth, more equity base, more profits, more it feeds in. And companies that have a high ROE tend to, over time, do pretty well. And coupled with the fact that we prefer lower debt companies means that most of it is happening through hardcore operating profits and at a lesser risk. We continue to look for companies with promoters having significant shareholding and where there's no dilution happening. On the wing side, we are looking for continuous growth in the top line, midline, and bottom line, as well as cash flows. We have also learned from some of the mistakes we have done in the past. Now we're being a bit more conservative in adding companies with more attractive valuations as opposed to expensive valuations. So this is something, and as the brand Maxium anyway connotes, data science and AI ML is very core to what we do. And we are able to pull a lot of research legwork because of the algorithms. But then again, end of the day, the investment committee, comprising of mainly Manoj, me, and another person, we look at the due diligence, trimming the sectoral exposures, etc. So I'll straight away jump to Jewel. If you see the sectoral allocation for Jewel, it is got a healthy mix of capital goods, finance, healthcare, automobile, mining, IT, etc. IT is only around 11%, reflecting what is going on in the industry right now. But we are pretty much optimistic about the core sectors here, which are going to power India's growth in the next few years. And most of them are, aligned to the Make in India theme. The sectoral allocation for Jewel has evolved over time, and this is basically the quarterly composition as captured in every quarter. As you can see, IT is relatively low right now, recently. Chemicals has also been up, and there is a good composition there. Capital gains has increased as capital goods has increased. Banks and finance continue to have a reasonable representation. If I construct a growth chart of the Jewel with Nifty NAV, this is how it's done over time. Now this chart looks good, but then if an investor has come, let's say at this peak, they would not see great returns for some time. And therefore, what we've done is we wanted to show different cuts of returns over this. So if you look at since inception, the previous slide had the since inception view, 118 versus 191%. And these are gross returns. We are not factoring in expenses, etc. These are gross returns. Whereas 3 years and last 2 years, it's been relatively close. But again, over the last 6 months, 3 months, etc., we've started doing much better. Even from a 1 year perspective, we've started doing pretty well. In terms of calendar years, 2022 was not a great year for us, following the huge liquidity glut in the market. But other than that, every calendar year, Jewel has outperformed the benchmark. And same goes, for financial years as well. Right from FY20, because the year we started August 19, there was COVID in March, April. So the fall in that financial year was much less for Jewel, and then the recovery also was actually better. And FY22 was fine, but FY2023 was not a great year because again the FY23 and calendar year 2022 are very overlapping. 75% of the months are overlapping, so that's where we took a hit. But then again, further after that, we have been doing pretty well. So again, this is a slightly different view of showing this. Maybe I should have just come to this rather than the previous slide. I also tried to capture rolling returns. A lot of data here. The Sharpe ratio of Jewel is better than the benchmark. The other ratios, financial ratios, are also better. And like I said, the trailing period wise, this is how it is performed. This is another interesting chart, which is rolling returns, because often an investor may come on a certain day when the strategy is at a peak, and then they may see different returns. So what I've done here is I've taken 1-year returns on every day. So every day, if I enter now, let's say if I entered on Jan 2021, 1st of Jan 2021, then 1st of Jan 2022, what would be my returns? Now, those annualized returns, those annual 1-year returns, if you take them, the average of those data points is 23% versus 19.7. And similarly here also, the median is 22 versus 14. Now, median is very interesting. Median is more reflective of what happens, it is not, median is not influenced by an extreme value at the top or at the bottom. So median is, the gap is pretty good. Then there's a standard deviation is high. And the maximum returns are high. The minimum returns also, Jewel, if you take the worst possible number for Jewel, it is Nifty is better than Jewel, but the best possible also is better, etc., etc. So I think this is one view in terms of rolling returns on Jewel. Similarly, I have another few charts for Spark as well. And here again, Spark, if you could see, the allocation to finance is much less, because in that 1,000 crore to 9 to 10,000 crore range, you will see most of them are related to hardcore businesses which are linked to manufacturing, etc. Pretty much, and this is done pretty well. Of course, there has been a boom in small cap over the last 3 years anyway. But if you see here, this is the sectoral allocation, how it has changed over time. This is NAV chart, and I'll skip this. Yeah, this is basically the returns over the last 3 months, 6 months, 1 year, and since inception for Spark versus the BSE small cap. Calendar years, this is how it is. And yeah, so this is the financial year view. Financial year 25 has just started. Our strategy for small cap is basically quality companies. And here also we are confident that if you pick quality companies over time, it will give great returns. We're very happy with the 31% gross CAGR that we've seen in this, and 31% as of 18th of June. Volatility is definitely higher. And this is again the rolling returns of Spark. From a annual returns perspective. So those are the main strategies. We also started a strategy called GEM in November, which we have not marketed it as much other than in one-on-one conversations. With the rebranding, we're probably going to talk about it a bit more. And GEM is basically a strategy which is following the Newton's first law, which is whatever is going up will continue to go up, and price trends will continue. Therefore, if you buy the strongest performers and cut the losers, you can make a good return in the market. And if you look at most phenomenon in life and in sports, you will see something similar. So key here is to spot when a particular tennis player or a stock is reaching maturity, and then figure out and then exit that. So here what we do is basically, as of now, we are picking stocks in the top 500, but we will probably increase the universe a bit more. Then we calculate the momentum scores, We apply the quality filter with the roots and wings that I talked about earlier, as used in Jewel and Spark. And then we construct a portfolio. We add a stock with an intent to keep it for at least a quarter. And then we rebalance it actually every monthly. So if something bad is likely to happen in the market, if we don't sense momentum signals, it means that market is probably going to really slow down. In which case we increase our cash position aggressively. Aggressively as in we become actually conservative, in the sense we increase the cash component all the way up to even 100%. But otherwise, if things are going well, then the portfolio rebalances every quarter. We don't check out a stock if it has not completed 3 months. This we've done extensive simulations, and there's a continuous monitoring. The quality filters also get fed into it. So if the latest annual results show that a company has got extremely high debt and very slow revenues, we will not pick that company, regardless of it being high on momentum. So this is a strategy that is, so this is something that we've done. We also, like I said, we try to sense bear market and increase the cash position. And this is the back-tested simulation on this. And this is an illustration again of how the strategy would have caught a stock like Ajanta Pharma in 2014 to 2016, and how it would have exited it. So the stock did do well even after it exited. But as far as GEM is concerned, this was the main golden period that it captured. Then we have, there's another example of Ramakrishna Forgings. Again, this sectoral allocation for this changes every month, depending on what is moving in the market. Yeah, so this is early days, but this strategy we're pretty confident. We did have some initial tweaks. The strategy did well, but in March, we found that we need to tweak our stop loss switches. And we did some tweaking on that, and and we've seen that the strategy has done even better after that. So this is how these are the main strategies that we're doing. And with that, I will stop my talk for now, and I will leave the floor open for any questions and answers. The other thing is we are our PMS is picking up steam. We have again, without much of marketing or any push as such, we've crossed 50 crores in our PMS just in the last 6 to 7 months. And we are seeing a lot of traction there, because strategies like like GEM are feasible only in a PMS model, because there's a more active rebalancing happening in them. The PMS is turning out to be convenient for clients who want us to take cash calls, who want the dividends that are coming to get reinvested. Because in the advisory model, what's happening is dividend money, when it comes, it sits in the bank account and it could get easily mixed up with other expenses. Whereas here in a managed PMS, it is there, and our pricing is also more aligned with the client interest. We have just hold on. I'm trying to stop the share here. Yeah, stop the share. I think there was some. So the PMS, like I said, is more convenient. There is a ability for us to take cash calls. There is a lesser fee compared to the advisory model. It's a win-win, because we also have less operational hassles, and we don't have to chase clients for contract notes. And even if one small contract note gets missed, the portfolio could get unaligned, and it becomes unnecessary pain for both of us to track it. The fee can be linked to performance in the PMS. So we have a very attractive 110 plan where the fee is only 1% management fee per annum. And there's a hurdle of 10%, and any gains above 10%, we share 80-20. So 80% is with you. Again, the hurdle is calculated after all expenses such as brokerage, custodian fee, etc. And we have appointed ICICI Bank as the custodian. We wanted a large and stable entity to do the custodyship. Like in advisory, the stocks will still be held in the client's name in a dedicated demat account. So we continue as a fund manager. I will manage the traffic of stocks, but at no point in time I will have custody of the stocks, because stocks will be in the client name. And the other advantages, like I said, is dividend gets reinvested. We can take cash calls. We can do strategies like GEM, for maybe 10-20% of the portfolio where you can take a higher risk. So that is it. Any questions, please do type in the chat window. I'll be happy to take them. So Basab says, what's the kind of return you're getting in the PMS at present? See, the PMS strategy and the advisory strategy are pretty much the same. So whatever returns I showed you earlier, those are the returns. But because the PMS started on a particular date, the returns will be as on that date, from that date. So I think by next week, early next week, we are going to upload a disclosure document for the PMS in our website. So Basab, you can take a look at that to get the exact numbers. But whatever I showed you earlier in terms of last 3 months, last 6 months, last 9 months or 1 year, those are the returns, that are there in the PMS also, because the stocks that we select are pretty much the same. As far as Jewel, Spark are concerned, GEM is available only in PMS. And we may have another strategy. We are working on another quantitative strategy which tracks business cycles and selects stocks from sectors that are at that point in time offering a great entry point. Either they're undervalued or the capex cycle is completed, and now the companies in that industry are ready to increase prices. The weaker players have been sifted out of the industry. The stronger players are now moving up. So those patterns do happen over 3, 5 years, 7 years across industries. So that is a strategy that we're working on for the last at least couple of years. We have not yet launched it, but likely that will also be available in the PMS model. All our strategies will be diversified strategies. We don't like pushing a flavor of the month or flavor of the year kind of a thing, saying, hey, this theme of capital goods is great, or hey, this theme of EVs are great. Whoever pushed EV last year, now EVs there is a big glut, there's a big price war, a lot of issues with the EV industry. So therefore, it's very easy for us, for a fund manager, anybody can go down to a small case and launch 30 baskets, and out of that 5 will do well. They can just market those 5s and kill the others. We don't want to play that game. We just want to give strategies which are well diversified and which will do well over a 5-year time frame. Minimum 3 years, but ideally 5-year time frame, where we are not taking punts, where the strategy will automatically pick the right company and not try to guess what is going to be the next flavor. So So that is basically so that is to Basap's question. Shubhamoy says, thank you, good insights. Just a quick word on the brand, the rebranding that I talked about. We did discuss with some of our clients. In fact, one of our client, Mr. Samir Pathak, is a branding guru himself, having worked in the FMCG space and large brands, large sports brands, etc. And he actually advised us not to go with a different brand. We were initially thinking of reverting back to Simply Grow as our brand. But given how branding works, there is a large broker by the name Grow. So if we do Simply Grow, even though our company was, the name company was pre-existing the Grow brand, there will be legal issues is what he advised. So that's the reason why one more reason why we looked for a completely new, brand. And I just wanted to acknowledge the timely advice given by Samir Pathak ji on this. Any other ideas, thoughts, questions, please feel free to use the chat box. If you want me to unmute, I can unmute you, but I just didn't want a lot of people speaking at the same time. Any questions, any thoughts? I think Manoj's views on the budget and what he said likely to happen after budget, that is also something. Any ideas or thoughts on that? Any questions? So Manoj, so what is the takeaway there from your point about potentially a market correction post budget with some of the expectation should we request clients to take some cash position or just see through that dip and rise after that?
Yeah, this is just to state that there could be dips, and we'll write them out. Not get unduly concerned about. So it's like you're going on a highway and there's a board saying sharp curve ahead. So that is all was the purpose for sharing that. No actions required. Wouldn't advocate anything in terms of timing or in terms of short-term strategies.
Rahul Jain joined late, but the question is, current market is bubble or is it okay? Manoj?
Yeah, so Rahul, we spoke quite a bit on this. We are in a long-term growth phase. It's like things are working out well for India as an economy, and that will reflect in better corporate performance. So just stay put and reap the rewards of being a patient investor. Don't worry about the markets will continue to go up and down. This is not to say that markets will go one way up, but remain invested is what we would advise. If there are no other questions, maybe we can probably close now.
Yes. Thank you for your time, and my apologies for the minor the logistics issue. It has never happened before, and I promise you that it will never happen again.
1 second, there's a question.
Further investment should be lump sum or SIP. Yeah.
Should I take it or will you?
So Rahul, there's an interesting slide I had. I'll just bring it back on rolling 1 year returns on any 1 year after any day that you invest. And obviously that will be a bell curve kind of a thing. So the median in the jewel strategy was around 24%. So therefore, there will be days when, let's say, there's a major correction exactly 1 year after you invested, so there could be a negative. But over a 3-year time frame, it will be really good. If you have lump sum, depending on, so for example, 4th June, we had advised clients to invest whatever money they could grab. That would have been a lump sum. But otherwise, you could, I mean, there's a saying that timing the market versus time in the market. The latter is always better. So therefore, in the long run, it doesn't really matter on which day you invest. So therefore, lump sum can be done. And SIP is always recommended as well, because SIP, without knowing, you will end up building a huge corpus, right? Depending on one's salary, right? If let's say one is investing 20% of the salary through SIPs or 30% through SIPs, I mean, in 15 years, they will be like earning a huge corpus, which is several times their annual expenses. And that's with wearing the financial planning hat, I'm telling. So please do both. If there is loose cash, please invest and do commit to SIPs so that your corpus grows into a huge number over time.
So I guess if there are no other questions, we can drop.
Yes. Thank you for your time. I look forward to connecting with you all one-on-one over the next few days. Bye-bye.
Bye.